Hi folks, welcome to this video which takes our previous problem that we did videos for in chapter 2, AJ Smith, and now what we're doing is we're doing the journal entries for it. So you'll find in this problem many of the descriptions of the financial transactions are in fact the same. There might be one or two different, but in essence most of them are the same, and what we're going to be doing is doing journal entries. So you remember the format of a journal entry is the debit credit format. So I just wanted to put up here some of the rules behind debit and credit, all right? So first of all, we know debit means left and credit means right. Debit does not mean up and credit mean down, or vice versa. It's got nothing to do with up or down, it's got to do with left or right. It just so happens that if you're looking at the rules of debit and credit and you're looking at assets and liabilities and shareholders' equity accounts, you'll know that if you look at this as a little t account here, right, little t accounts here for your assets, your liabilities, and any equity account, right, little t accounts, all we're saying is that this part is the left and this part is the right. This part is left, this part is right, and similarly with equities, left and right. But if we look at assets, when we debit them on the left because debit means left, and when we do that, their balance goes up, right? It increases. So the theory is that if you wanted to decrease an asset, you would do it on the right, and right means credit. It's the opposite, right? So now, what happens to a liability? Well, a liability would get bigger on the left, would get smaller on the left, and left means debit. So a liability would get smaller on the left, right here, smaller or negative on the left, and left we know means debit. So clearly if we wanted to increase a liability, we would do it on the opposite side, and that's the credit or right side. All right. Now, one of the things you'll notice is that if you look at assets and liabilities and equity here, you'll notice that assets work opposite to liabilities and equity. And that kind of makes sense because liabilities and equity are on the right-hand side of the equal sign, right? So if you think of this as the balance sheet equality thing, right? If you think of it that way, then you know, I'm trying to see if I can reformat this to look like the balance sheet equation. Might be a little bit challenging, eh? Anyway, I think you get the drift. Anything on the right-hand side of the equality will behave the same in the T account, right? So we find that liabilities will go down on the left, so they'll go down with negative on the left, and left means debit. Same thing with equity. We saw when we had retained earnings decreasing, it decreased on the left, and left meant debit, right? And why is that? Because when equity goes up, okay, on the right-hand side, when equity goes up, we would credit it. What kinds of accounts or equity-related accounts would make equity go up? Well, we said revenues would, right? So revenues and expenses are two examples of accounts on the income statement or statement of income that have an impact on equity, and they have that impact through retained earnings. So again, you'll remember our little clip, right? You'll remember here that you've got revenues and expenses. The difference between the two make up net income when revenues exceed expenses. But the idea here is this. We can see that when revenues go up, they're credited, right? So it would make sense that it would increase equity because revenues increase income and income increases retained earnings, which is an equity account, right? So you'll notice here that there are some similarities. So when we've got things like equity going up, that means revenues are going up. And when they go up, they both go up on the right, and right is credit. You'll also notice here that equity goes down when it's debited, down meaning minus, right? And when we debit it, or on the left. What would make equity go down? Well, when expenses go up, right? Well, expenses go up on the debit side. So it makes sense in this case that when expenses go up, equity goes down, right? Equity goes down. So when expenses go up, we debit. When equity goes down, we debit, right? When equity goes up, we credit. When revenues go up, we credit. So you have to get straight in your head that expenses increase on the debit side, and that also reduces shareholders' equity, which is debited, right, on the left-hand side. So there's just a few little rules that you have to remember, and I took this from your course guide, okay? So if you wanted to go in and have a look at that in Unit 1, be my guest. But in any case, let's move on with our question. So you'll notice here that when A.J. Smith issued shares for cash, they got cash in. So we said in the transaction analysis that when cash goes up, it goes up on the left, and left means debit. Well, we have also just seen here that when assets go up on the left, that means debit, right? So in our case here, we're going to debit cash for $300,000 and credit common shares, which is an equity account for $300,000, right? Why would we credit common shares? Well, our equity is going up. Our shareholders' equity is going up because the total dollar value of common shares is going up. So when equity goes up, it goes up on the right, and right means credit. So whatever the account is that makes equity go up, that's what we're going to credit. In our case, it's common shares. Now with the land and buildings that we bought for cash and common shares that we issued, we've already determined that land and buildings were going up. They're assets. When assets go up, they go up on the left, and left means debit. So again, when assets go up, they go up on the left, and left means debit, right? So with that in mind, our assets are going up, but we also have an asset going down, which is cash, and our common shares are also going up. And again, remember that when an equity account goes up, it goes up on the right, and right means credit. So whatever equity account is affected is going to be credited. So therefore, if we go back to our example, we have that to be common shares. Now I want to stop for a moment to show you something that is always a rule in accounting. The total dollar value of all debits and credits processed on a transaction by transaction basis are equal, meaning that in every transaction that I journalize, right? So journalizing means setting it up in debit credit format. The total dollar value of debits equals the total dollar value of credits. The total dollar value of debits here equals the total dollar value of credits here, right? So you'll find that to be something of a rule, okay, in accounting. So what about when we took in cash? When Frantech paid us $7,500 at the end of every quarter for 4 quarters. Well, we took in cash, so our cash is an asset. When an asset goes up, it goes up on the left, and left means debit. When an asset goes up, it goes up on the left, and left means debit, right? So similarly, we had rent revenue, which was an equity related account. And we said that when equity goes up, right, when equity goes up, it goes up on the right, and right means credit, okay? So the account that we have to credit an account to make equity go up. The account we're going to credit is a revenue account, right? So we've got a credit to $22,500 to rent revenue, and then don't forget in this question, we took in a check from Frantech on December 30th, but that's not for until they're going to rent the premises or have their tenancy in the new year. So because we're taking of that $30,000, $7,500 of it represents the December 30th payment. So our credit goes to unearned revenue here, and that's a liability. So in our case, what happens, the liability is getting bigger. When it goes up in the right, and right means credit. So you'll notice liabilities and equities, the T accounts are the same, but on the asset side, it's the opposite of what it is. So anything on the right-hand side of the equality is the same. On the left-hand side, we only have assets, but that's how they're handled, opposite to these guys. Because here a debit makes them go down, here a debit makes them go up. Here a credit makes assets go down. Here a credit makes liabilities and equity go up. Right? So the rules are a little bit different for assets as opposed to liabilities and equity. So now let's complete the rest of our transaction analysis. So now you'll notice in transaction 4, we have a couple of entries here. What the authors have elected to do when you recorded the purchase of your equipment for $120,000 is they said, well, we're going to credit cash because we paid cash of $60,000, right? So don't forget cash is going down. And when an asset goes down, it goes down on the right, and right means credit, eh? So now you've got your asset going down, you've got your equipment getting bigger, going up, and don't forget, because you didn't pay for the whole amount of equipment, it took back a note payable saying you agreed to pay at a later date, and this is a legally enforceable promissory note. But don't forget, there was also interest on the note. Remember from the question, the note was made on July the 1st at a 10% rate of interest. So 60,000 times 10% for 6 months of 12. Remember, every time they state an annual rate, unless when they state a rate, unless they tell you otherwise, it's always annual. So now we would make an adjusting entry to debit the interest expense and credit the interest payable because we haven't paid that yet for $3,000. Now, for inventory, what are we going to do? Well, we bought inventory and we bought it on credit, so we didn't pay for it. So we have to set up an obligation or a liability that recognizes the fact that we're going to pay for this inventory we bought at a later date. So when your liability is going up, again, if you go back to your sheet here, your liability, when it goes up on the right, and right means credit. So what does that mean? That means that when an asset goes up, it's going to go up on the opposite side, which is the debit side, and debit means left. Okay? Now let's look at your credit and cash sale in number 6. We know that we made a sale of $300,000, but they told us some of it was collected in cash and some of it was customers would pay us later, so customers purchased on account. So that means two things. If you have a look on the debit side or the left side of that equation right now, you'll see here what? You'll see that cash is going up because we collected cash. Cash is an asset. And when an asset goes up, it goes up on the left, and left means debit, right? So, same thing with receivables. They're also going up because we're accepting somebody's promise to receive their money or to allow them to pay us later. So they're an account because they're a customer and we're waiting to receive their money. So it's an asset because we have a claim on their future promise to pay, right? So we're going to debit accounts receivable because it's an asset and it's going up, and it goes up in the left, and left means debit. So now don't forget, the total dollar value of all debits and credits has to be equal. So I need a credit of $300,000. And they did say that they sold these items, so it should be obvious to you that we're going to credit the sales revenue account. So again, revenue is going to go up. But revenue, don't forget, is an equity-related account. And when revenues go up, they go up on the right-hand side, right? And right means credit, and that will make your equity go up on the right, and right means credit. So now we've got our sale of inventory. So when we made the sale up here in item number 6, the inventory also, quote unquote, left the building, right? So it's gone. So what do? We're going to credit our inventory or reduce it by 190 and debit our cost of goods sold. So now don't forget, cost of goods sold is an expense account, and expense accounts get bigger on the left, and left means debit, right? So if they get bigger on the left, left meaning debit, then all that means is that we are going to debit or increase our cost of goods sold by 190,000 and credit or reduce our asset inventory for 190,000. Now, some of those suppliers that we bought from on account in number 5, we're now paying them off. We're paying off 205,000. So that means if we're discharging or paying off a liability, that liability is going down. So if we go back to our chart, we got liabilities going down, and they will go down on the left, and left means debit. So we're going to debit accounts payable, and don't forget we're using cash up because we're paying our liability. So what does that mean? That means our cash is going down. Cash is an asset. When assets go down, they go down on the right, and right means credit. Okay? Now we've got our customers paying us. So we notice in transaction 9, we sold $250,000 worth of stuff to our customers, right, who paid us on credit, but now we're collecting from them. So during the year, we collected $200,000. So what does that mean? That means AJ Smith's cash is going up, and cash is an asset. And we know that when an asset goes up, it goes up on the right, and right means debit. Okay, and we also know that we have an asset going down because if the customers are paying us, we are no longer waiting to receive any money from them because they've paid us. So for those people that have paid us, we're going to reduce the accounts receivable for them because we are no longer waiting to receive their money. They've paid us, and that's an asset account. So you'll notice we have to credit that asset account. Why? Because it's going down. So if we go back to our T accounts, we see that when an asset goes down, we credit it, right? So we've got that piece. So now we still have some entries to do, but I think what we'll do is we'll take a little bit of a break right now. Make sure you can digest this, and then we'll come back and finish off the rest of the entries.